My name is Adam Sweet. I'm a principal with Eide Bailly. I will be leading it off, and I'm joined by a couple other of my colleagues if they want to introduce themselves.
Hello, I'm Ava Archibald. I'm partner in charge of our Wealth Transition Services Group. And I'll be giving you an update on the estate taxes and the environment we're in that regard.
I'm Ben Peeler. I'm a partner in charge of tax controversy and procedure, and so I'll be going over some sort of hot topics in the world of the IRS today.
Very good. So thank you everyone for joining us this morning. We're hopefully next year we can do this in person, but at least this year, thanks for joining us remotely. So I should have said, so I'm Adam Sweet, obviously, but I lead our pass-throughs group. I sit in Spokane, but I'm the principal in charge of our pass-throughs group, so S Corps and partnerships. All right, so I wanted to start with just updates on the BBA partnership regime. And we'll get into why that's relevant for this year. But just by way of background, BBA is the Bipartisan Budget Act of 2015. And what that really did was change the landscape for the auditing of partnership tax returns. It repealed the old rules, which were known as the TEFRA rules. And really the big change is if there's an assessment, if the IRS comes in and audits your partnership, if there's tax due, the default rule is the partnership pays the tax in the current year. You know, under the old rules, it would have been the partners are ultimately responsible for their share of the tax. You can make what's called a push out election. If you don't want to pay the default level tax, you could make a push out election. There's no longer a concept of a tax matters partner. If you look in old operating agreements, there's references all over the place to a TMP or tax matters partner. That person is gone. The new role now is called the partnership representative, and they're the person that's in charge of dealing with the IRS if you are audited or if you're filing for a refund. The big point there is the partnership representative, or the PR, is a very all-powerful position. The TMP was a very weak position, meaning other partners had rights to intervene, other partners had rights to object under the old regime. With the new BBA rules, really, in front of the IRS anyways, the PR has ultimate power to extend statutes, to settle cases, to decide to go to litigation, and so forth. So a much more powerful role, and it's a role that everyone should pay more attention to. But specific to 2020, these rules also apply. These rules not only apply when you're being audited by the IRS, but they also apply when you are filing an amended partnership return. And this became very relevant here over these last couple of years, because originally we were thinking the BBA rules came in effect for the tax year 2017 and forward. So if you do the math, 2017 returns were filed in 2018. We were thinking, well, it's going to really be a couple of years before we see IRS audits, to be 2021 before we see IRS audits. And then we'll start to see how these rules work. But like everything, we were surprised, because the first issues that come up are people having to amend their returns. And they came up last year if you got a late K1, or if you had additional information come in after a 1065 was filed and you had to amend the tax return. You had to do it under the BBA rules if you're subject to them. And then this year, with the various CARES Act provisions that were passed, which we'll cover here shortly, to take advantage of those, if you've already filed your 1065, you had to amend. And it's not as simple as it used to be when it comes to amending a return. This little box here is I put this together a couple of years ago, but it just shows what are the options under this BBA regime. And I should have said it in the beginning, but not all partnerships are subject to the BBA regime. If you have 100 or fewer partners, and if all of your partners are individuals or C corporations or S corporations, you can opt out of these rules. But if you're subject to these rules, these are the various options you have. The option number 2, if you're subject to it, would be that you pay the tax. And option number 3 would be that you push out the adjustment to your partners. So when you're amending a tax return, so if you're amending a 2020 tax return, if your partnership is subject to these rules, you have the same choice. If you're amending a return and there's additional tax due, you could make a choice to have that paid at the partnership level or push it out to the partners. If it's a favorable adjustment, meaning it's going to result in a refund, well, then you would have to push that out to the partners. You can't actually claim a refund at the partnership level. So the big area that came up this year was the fixed QIP, qualified improvement property. It was intended to be bonus eligible as of the TCJA passage at the end of 17. Due to a glitch, a statutory glitch, QIP property was not bonus eligible, and it was, if you actually read the conference reports, it's pretty clear Congress intended it to be bonus depreciation eligible, but was not. So anyone for 2018, 2019, anyone who had qualified improvement property, if you hired someone to do a cost segregation study, you had a whole chunk of your real property, or a whole chunk of your property that wasn't bonus eligible. Everyone knew that Congress wanted to fix it. They just needed to find the right vehicle to fix it. And they finally did this year with the various pieces of COVID legislation. And they made QIP bonus eligible, and then they made it retroactively effective as of 1/1/2018. So it's almost as if the TCJA glitch never happened, that as of 1/1/2018, the effective date of the Tax Cuts and Jobs Act, that QIP was bonus eligible. Problem there is, well, what do you do if you've obviously filed a return, for the 2018 tax year that would have been filed last year? For the 2019 tax year, if you had already filed it before this fix was made, what do you do? And you have a couple of different options. There was a revenue procedure 2020-25 put out this year by the IRS that gave taxpayers a couple of different options. One, you could file an amended return if eligible. Two, you could file an administrative adjustment request. Or three, you could file a 3115, which is a change in accounting method, to catch up kind of your lost depreciation from previous years. And I have a slide here in a second if you're wondering what the difference between all these are. I have a slide coming up that will outline the kind of benefits and burdens of each. But really briefly, an amended return generally would only be for a partnership that is not subject to the BBA rules. An AAR would be for a 1065 partnership that is subject to the BBA rules. And then a 3115 would be for anyone. And the 3115 is a catch-up item in the current year versus an amended return or an AAR relates back to a previous year. So if it's 2018 that you put the QIP into service, if you're amending 2018 or if you're submitting an AAR, both of those would relate back to the 2018 tax year. If you file a 3115 to catch up that depreciation, that would relate to your 2020 tax year. The other revenue procedure that came out was Revenue Procedure 2020-23. And this gave partnerships that are subject to the BBA an exception to the rules. And why this is beneficial is if you're subject to the BBA and you're audited by the IRS, let's say, the adjustment is taken into account in the current year. So if the IRS audits your 2018 tax year, but they audit it in 2020 and they make an adjustment, the adjustment is taken into account by the partners on their 2020 tax return. So it's going to be when they're filing their tax return next year that they take that into account. Same rules apply for an amended return. That if you are subject to the BBA rules and you amend your 2018 return, but you do it in 20, if there's a positive adjustment, the partners only take that into account on their 2020 tax return, which would be next year. So that kind of flies in the face of, the CARES Act was supposed to provide kind of instant liquidity to affected people to, if you think about the NOL rules, the QIP rules, and so forth, that was supposed to provide instant liquidity. The BBA rules really would have slowed that down. So what the IRS said was for certain affected partnerships, even if you're subject to the BBA rules, you can basically treat it like those rules don't exist and amend under the old rules. and amend a return now, and which would allow your partners now to go back and amend their returns for those years and get an instant benefit. A couple of key dates there were, one, this only worked for returns that were filed before the issuance of RevProc 2020-23. I think it was like April 7th. And then two, to take advantage of this, you needed to do it by September 30th, 2020. So that date is obviously passed now. But if you were able to take advantage of it, or if it was out there and you were wondering what is the significance of that September 30th date, that is the significance there. So if you are a 1065, if you're a partnership, and you're considering, and let's say you want to take advantage of the QIP fix, or the NOL rules have been changed, the loss limitation rules have been changed. It's a little bit beyond the scope of today's presentation, but suffice to say, you want to amend a 2018 or 2019 return to take advantage of some of these statutory fixes. Well, your first option would be, if you're not subject to the BBA, so you have 100 or fewer partners, none of your partners are pass-through entities, you don't have any grantor trusts as partners, you can file a Form 1065X, which is just an amended 1065. It's the same 1065X that you've always filed. You could do it this year. You're going to have amended K1s, and then the partners would also file amended tax returns with those amended K1s, and potentially that would provide kind of instant access to a CARES Act benefit. So if it's QIP, additional depreciation, the 1065's amended K1 to the partner files their amended 2018 tax return right now. And if it's a refund, and if the IRS is moving quickly, then you receive that right now. If you're not eligible, so if you are a 1065 subject to the BBA rules, so you have more than 100 partners, or if you have another partnership that's a partner in your partnership, if you have a grantor trust in between, a disregarded entity, you can't file the 1065X. You file instead an administrative adjustment request. The advantage there would be partners don't need to file amended tax returns. So if it's the 2018 year in AAR, you file it this year. Partners don't go back and amend their 2018 tax return. But what they do is take the item. So if it's QIP again, if you have the partner's allocable share of the QIP fix, then you would issue a statement to your partners in the 2020 tax year, and then they would take those items into account when they're filing their 2020 tax return in next year at whatever point. So there'd be the delay there. They're not going to get the benefit of that until next year. Your other option would be to file a 3115, which is a change in accounting method. You can basically run the benefit through the current year. So whatever depreciation you've lost in the previous years, you can run it through this year, which would be the catch-up amounts. Again, it's going to affect the 2020 tax return. So the benefit is going to be realized by the partners when they file their 2020 individual tax returns next year. It does create, effectively, if there's a loss, it will create an NOL, and the NOL rules have been relaxed. Under TCJA, NOLs could not be carried back, and they were subject to an 80% taxable income limitation. Now until 2021, NOLs can be carried back 5 years, and they can go against 100% of taxable income. But there's also a question of timing here, because if you file a 3115, the 5-year look back would be 2020, would be back to 2015. Versus if you were eligible to file a 1065X for the 2018 tax year, carrying that back 5 years, that go back to 2013. So there could be a little bit of gamesmanship here where you maybe are looking back to figure out what year do you want to carry that loss back to. Is there a year that you were extraordinarily profitable, or you had partners in a high tax rate where the loss is going to be more beneficial to them? You could materially impact that depending on, do you do the AAR, do you do the 1065X if eligible, or the 3115, which anyone could do. So it's a good topic to keep in the back of your head, and also talk to your tax advisor as the year closes out. If you're looking to take advantage of some of these CARES Act changes, there may be multiple ways to do it, and they may produce different changes, let's say, or different benefits for your partners. So we'll shift topics a little bit here. There's also been some big changes this year to the Opportunity Zone program. And before we kind of dive into those changes, I think it's always good to level set on what is the Oz program. So this is just kind of a simple chart here showing what the tax benefits are if you invest into an Opportunity Zone. If you have eligible gain, if you invested in the 2020 tax year, you can defer that gain. If you hold your investment for 5 years, you get a free 10% step up. In 2026, you have to recognize your deferred gain, but it'd be minus the 10% step up. And then if you hold your interest for 10 years, your investment for 10 years, all of the appreciation you could exit tax-free. So you could sell your Oz interest or sell your Opportunity Zone assets as long as everything's been held for 10 years. All of the post-investment appreciation, you could exit with a big pile of cash and no tax bill. What is a qualified, Opportunity Zone investment? Generally speaking, you can't go in and just buy property in an Opportunity Zone. You actually have to invest into a fund called the Qualified Opportunity Fund. It can be a state law LLC, LLP, whatever you want. There's rules for a QOF has to hold 90% of its assets as good assets, which are called QOZ property. QOZ property can be stock, a partnership interest, or other types of QOZ property. If it's QOZ stock and QOZ partnership interest, those in turn need to hold good assets. The key point here is this all relates to things that you need to acquire post 2017 because that's the effective date of the Oz program. Timing wise, if you have qualified gains, you generally have 180 days to invest those gains into a QOF, Qualified Opportunity Fund. There are, of course, special rules for partnerships and S corporations. If you get a K1, it can be 180 days from the due date of the partnership return or the S corporation return. And then if you set up a fund and put gains into a fund, and if you purchase existing assets, you need to substantially improve the assets. And substantially improve the assets means $1 of improvement for every $1 of cost, not including land. So if you buy an existing building in an Opportunity Zone for $1 million and 500,000 goes to land and 500,000 goes to the existing building, you'd have to put an additional 500 grand into the building to substantially improve it in order to have good Oz property. Compare that to buying raw land. If you buy raw land, all you have to do is build something on it. There's no dollar for dollar requirement necessarily. Something called a working capital safe harbor that quite a number of the deals we've worked on have used. And what this lets you do is raise capital and then have a period of time to deploy that capital. As long as you have a plan in place for how to use it, I have kind of laid out the terms here. The reason why this is important is otherwise, if you park cash into a QOF or QOZB, cash on its own does not count as a good asset. And there's testing requirements for a QOF and a QOZB when you file your tax return. You actually have to say, we the QOF and we the QOZB have done all the right things, including owning the right types of assets. And a wrong type of asset is cash. So this is very important, this working capital safe harbor, because oftentimes deals are going to raise money and it's going to take a couple of years to put all that cash to work, right? As you look for permits and as you, as you go along, if you're building a big piece of real estate, it's not going to all happen within the first year. So this lets you sit on that cash for a period of time if it's reasonable working capital. So what happened this year? Well, due to the COVID, emergency, we had Notice 2020-39 from the IRS that gave kind of a number of material changes to the Oz program, temporary changes, not permanent, temporary changes, but still important changes for the 2020 tax year. The first portion of that is if your 180-day period to invest gains would have ended between April 1st and December 31st, 2020, you can deem the 180-day period to end on December 31st. So if you sold a piece of property February 1st, ordinarily 180 days would have been sometime in October. You can automatically extend that to December 31st to invest your gains into. The second thing the notice did was relax. As I mentioned in the beginning, the QOF, you have to have 90% of your assets be good assets in a QOF. And that's testing that's happens semi-annually at the mid-year mark and then the end of the year mark. If your testing date falls between 4/1 and 12/31/20, you basically are automatically relieved of this testing. And they do it and they waive the penalty for this. Just temporary, this won't be in effect for 2021, but at least for 20, don't have to worry about this testing. And then also the substantial improvement test I talked about, that dollar for dollar improvement standard. You generally have 30 months to make substantial improvements, and you're going to get a tolling of between April 1st and December 31st. So you'll get an extra 6 months, extra 7 months on top of that, added to that. So effectively, you'll have a 35 or a 36-month period to substantially improve your property. Also, the working capital safe harbor, which I just covered a couple slides ago. Remember, again, what that lets you do is raise working capital. And as long as you have a plan in place to use it and the plan's reasonable, you can kind of deem that cash to be a good asset. Ordinarily speaking, that's a 31-month period you have to use the cash by. So once you raise the cash, you have 31 months to use it as part of the working capital safe harbor. This notice 2020-39 from the IRS extended that by 24 months. So effectively, you have 55 months to use your working capital and put it to use. And this is if the working capital is held by the fund before 12/31/20, and provided that you meet the other requirements for the safe harbor. So that's a big deal. Having an extra 2 years to use the cash gives a lot more leeway and a lot more flexibility to funds. If you're raising a lot of money and you ran into construction or permitting issues because of COVID, you're going to now have an extra 2 years effectively to place your project into service. And then finally, there's rules for if you put gains into a fund and then a fund buys assets and then the fund sells those assets before the 10-year mark, you have a period of time to reinvest those funds into another project. And during that time, the cash from the sale counts as a good asset. They extended that by 12 months. Now, just remember here, if you do this, the gain from the sale is still taxable. This rule allows you to roll the funds over, and so the cash is deemed to be a good asset, but the gain would still be allocated out to the QOF owners. And then finally, this came up a few times. There's an election statement that you have to include if a QOF is a partnership. So if it's an LLC classified as a partnership, which probably 99% of the QOFs out there are classified as a partnership, not necessarily LLCs, but they're state law entities classified as partnerships. Right now, you have to file the 8996, which is the election to be a QOF, and there's some other statements on that form. That has to be filed with a timely filed Form 1065, which includes the extended due date on the 1065. If your 1065 was due on 3/15 and you did not file the 8996, there is no relief right now for that. There's no COVID relief for that, because remember, the COVID relief only comes into effect for returns that were due after, I think, April 4th or April 5th. So the only option right now is actually having to seek a PLR from the IRS, which is an expensive and burdensome process. So we'll see if there's enough people out there asking for late relief, maybe we'll get some type of automatic relief in the form of a revenue procedure. But right now, anyways, remember that 8996 is due with a timely filed 1065. If you forget the 8996, you can't go back and amend the 1065 or file the 8996 late because it's not valid at that point. Your really only option at that point is to seek relief from the IRS. We're happy to help if this has come up, if this is triggering an alarm bell for someone that filed a 1065 back in March. Feel free to reach out. We have run into this a few times, and we can happy to share our thoughts. So with that, I think maybe I'll take, if there's any questions, one question. So with opportunity zones, the person realizes a gain in year 6. Yeah, so the question was, how does that work with the gain being recognized in 2026? So let me just give you a really quick example. If I sell stock this year and I realize $100 of gain on that stock and I invest it into a QOF, and my basis in the QOF is $0 because I didn't pay any tax on the $100 I put in. In 2025, I get an automatic $10 step up. In 2026, I have to recognize the rest of my deferred gain, which would be the original $100 minus my $10 of basis. So I'd pay capital gains tax on that $90. If I then hold my interest for 10 years and I sell my interest for $300, so I invested $100, I tripled it, I sell it for $300, that $200 of appreciation is tax free. So hopefully that helps. Good question. If there's any other quick questions, looks like we've answered them all. So with that, I'll turn it over to Ben.
Thanks, Adam. So I'm going to discuss today just a couple of the things we get the most questions on in the IRS world and what the IRS is battling, so to speak. My slides are intended to be, pretty inclusive. They have all this information in it. I'm not going to go everything in the slides, so please, if you can get, I think you can get copies of them and you have questions. These are very nuanced issues, so I'm going to give you a brief overview of some of the things that are going on, but if you have questions, can't answer from the slide, just come to me. So today we're going to go over the micro-captive insurance transactions. It's basically kind of what the IRS is after and what their new settlement proposal is. We're going to talk a little bit about penalties. There's not too much updated. There's some slight changes, but mostly it's just a matter of, kind of position yourself to prevent them. And then we'll talk about conservation easements, specifically a little bit about syndicated easements and some recent cases. So right into the micro captives. Again, not a lot of information in these slides. Can't go over all of it. We'll run out of time. But most important things here is that the IRS has really decided to go after micro captive transactions. Now, what does that entail? I mean, there's lots of different micro captives, which we call 831B captives. They're captives where there's no tax on the premiums paid to the captive if they stay under a certain threshold and meet other requirements. And the IRS has kind of broadly attacked those. Now there's different ones. And I would say the best way to differentiate is there's a lot of what we call F&I captives, which are dealership vehicles usually. They're selling financial products that relate to the sales of the cars. There's other offshoots from that, but those are typically not what the IRS is after, since that's sort of third-party risk that they're selling a product to someone buying a car. We're talking about what we call enterprise risk captives. That's where the captive is insuring just the risks of the operating business itself and not third-party risks, things like that. And typically the IRS has kind of got a whole bunch of angles that they're taking, but the main thing that they're doing is it's sort of attacking generally what they call the quota share pooling arrangements, amongst other things, but that's how you tell the difference. So just so you know that if you have one or have anyone know of anyone that has, everybody's been recently getting these 6336 letters from the IRS that basically want people to put up or shut up about their captive. They're sort of a threat letter to try to get people to decide whether they want to keep the captive or not. And this letter asks them to say, well, have you stopped using the captive? And if so, when? And then it says, if you haven't stopped, you need to go talk to a professional to see if it really is valid. And then, scaring them into amending, things like that. So a lot of things I'll say about this today, kind of my opinion. There are different opinions about how to approach these IRS attacks. But circumstances change, depends on the facts, things like that. But just know the IRS is actively auditing. They've just launched a new stretch of audits that are a campaign that comes from LBNI, the Large Business and International Division. So they're really attacking this hard. So one thing they threatened is that they're going to use the economic substance doctrine, codified economic substance, which allows them to assert a 40% penalty if there's, no economic substance and there's really no business purpose aside from tax. That's been their tactic for several years to be using this, so it's not new, terribly new. What kind of is new is that they are sort of drawing lines in the sand where they're saying, before we weren't going to let you out of penalties, or we were going to let you out of some penalties, now we're not. And then they changed their mind. So I'll go a little bit in that, but just some basics. These slides just talk about some of the important things that must be established in a captive. They're beyond our discussion today, but they're important if you want to make sure you or someone else has this properly set up. These are the guidelines. You'll hear words like risk shifting and risk distribution, and whether your insurance is a fortuitous type of insurance, because really the IRS doesn't consider something an insurable product if it's not fortuitous, meaning that they're unknown risk. It's a business risk if you I know that I'm gonna have so much default and things like that. And it's just how am I going to deal with that as a business risk? So some of the things that you might want to do when considering a captive is to keep all this sort of information in, why it was formed or why you're going to form it in your files. And one is, were the risks that are insured, why were they selected? This is important because this is connects the premium and the insurance you picked with your loss history and the things that had affected the business in the past. If there's disconnect from that, the IRS gloms right onto that, saying, well, you're really picking risks that aren't going to occur, and so you're just trying to put money aside and get a tax deduction for it. So these are some of the steps I usually advocate and others do. Basically take a look at your loss history. Of course, everybody should have done that, but also talk to your business and risk advisors about why it would be, should be covered, and especially your insurance advisors. This is not going to go too much into this, but risk distribution is the sort of the main problem the IRS is focusing on. They believe that a lot of these micro captives don't have risk distribution, which is, if you have a whole bunch of risk pooled together, then everybody in that pool has a little bit less risk. So it's distributed amongst everybody and makes it, what's important for insurance is that it's not just all on one person taking on that risk, because that's just self-insuring or putting a pile of money aside for yourself. So this just goes over some of the ways people get risk distribution, but what the IRS is going after is a lot of people have said, well, I'm going to park a little percentage of my risk pooled with other people so that I can get that risk distribution. And that came from that notice 2002-89 as like a 50% threshold. So the IRS disagrees that a lot of those products out there worked, because if you didn't, then you got pushed more toward a group captive or something like that. All right, so then the only thing I'll mention from this slide is that one of the new things out there is a lot of people are angling away from what the IRS has attacked in these quota share pools to sometimes more often to what they call the rent-a-center kind of ruling, where if you have enough, even though you don't have a bunch of entities that were talked about in IRS rulings, but that if you have sufficient statistically independent risks, then you might have enough risk distribution with just brother sister type entities instead of having a whole bunch of other involvement. So that is one that people are doing. I don't think that's been tested or really attacked by the IRS yet, but is very common in the new creation. So the recent cases that people might have heard about that they lost, the taxpayers lost, were Syzygy, Reserve Mechanical, and Abrahami. In these cases, the IRS sort of goes to an intent angle, and I don't know that the courts actually ruled on that, but they certainly made their examinations about the emails and the things you discussed more so than whether you had risk distribution. But the courts seem to just disqualify the risk distribution or other aspects of the captive. Notably though, the IRS didn't win any penalties in any of these cases, and one, they weren't even an issue, yet the IRS is still pushing for these 40% penalties. So just to push a little bit past some of this, since it's I I want to go into kind of what the IRS is doing now. What the IRS is doing now, as you might know, everybody that had one of these, it became a listed transaction, and they had to report the fact that they had one on a Form 8886, and that has sort of given them this pool of people they can now audit. The IRS has, it was kind of a COVID delay, but now they've made good on that threat, and they're auditing lots of people. So audit notices are flying around for everybody now, and so everybody's wondering, well, what should I have done? What should I do? So one thing, at first, the IRS was saying, well, we're not going to agree to anything in these cases. We're going to assert 40% penalties. If you didn't return the 6336 letter, we're assuming you vetted it with your own advisors, and that's why you kept it going. And if we disagree that it works, we're going to assert the 40% penalty. Some invisible back and forth there with the industry and the IRS, but they finally did just a few weeks ago, really, say, yes, we are going to offer another settlement. Now, there was a previous settlement that was like a 90-10 settlement, is what people call it, where you gave up 90% of the deduction if you were audited and you wanted to settle. And the IRS would give up 10%, and you could have penalties reduced to 0 if you had reasonable cause for, and you received advice for setting it up. Now this new settlement is not as good, so I'm just going to break down. One of the most important things is, of course, to settle, you have to pay the full balance of the deficiency in the settlement, or if you don't have the money to do it, you have to prove financially you don't. That's, can be stringent for some people. But the main thing is that now you have to give up 100% of the deduction. And then also they have an accuracy penalty that's 15% and can't be reduced to 0. Before, you could reduce it to 0, depending on what you could prove. Now the penalty, the lowest, goes 5%. And there's also, there seem to be asserting that there'll be a penalty both on dividends paid out of the captive in liquidation and from the deductions that you lost. So, of course, in all these settlements, they've required liquidation of the captive and discontinued use. But now this, be putting a penalty on that, a minimum of 5%. So you can get the penalty reduced if you, couple things. One, you got to not have been in another reportable transaction previously. Also, you have to prove that you got independent professional advice. That only gets you 5%, which, theoretically that could get you 100% if you took it to court, but who wants to pay that to go to court? So most people will end up probably taking a settlement like this, but they just have to know that there's limited reductions. So, and the IRS will still require liquidation of the captive and that sort of thing, as well as they, when you close it out, you're gonna have to pay tax on all the dividends that were put in previously from premiums that they couldn't get because they were beyond the statute of limitations. So you end up paying much worse tax rate plus penalties and fees than you would have. So one other option that I promote is, considering the fact that so many people are going to be examined, you can, before you're examined, consider doing something like amending your past tax returns and paying the tax for the premiums that you paid, and then you can still make protective claims to get that money back, assuming later on a court case is won that supports the use of the captive similar to yours. And the reason why I advocate this is because it gets rid of the penalty, because as long as you amend before the IRS comes knocking, then theoretically it's a qualified amended return and they can't apply the accuracy penalty. You might have to pay some other penalties, like failure to pay penalty. But oftentimes, if you were advised that it was okay, you can fight that penalty separate and apart from an audit like this. So it can put you in a better position. You can even keep the captive going, just not take deductions. And then technically, you may not even be required to report an 8886 because you're not getting any tax benefit. Especially if it gives you good insurance benefits, this can be a great angle. So it's another option you can do instead of waiting around to see if you get audited. But this doesn't mean that the captives are bad or that anything is wrong with them. It just means that the IRS has a difference of opinion and it'll take years to figure out where actually the good ones and the bad ones are. And everybody's being scrutinized. There's not a single group or company that creates captives that hasn't been subject to IRS investigation. And it's sort of a bully tactic by the IRS since they can't get to everybody. And I'll move on to the penalties. Now, the penalties, one thing I just wanted to note here is a lot of people ask me about, well, I heard that the IRS, got blocked from asserting penalties in examinations because they weren't doing something correctly or their procedures were wrong. And sometimes people ask, well, can I go back and get mine, taken off since I agreed to them and I shouldn't have? Well, this all comes from the 6751B. I think I skipped one slide. This is where, there's a code section that says the IRS can't apply a penalty unless the supervisor signs off on it. And then there was a case called Clay versus Commissioner, where the tax court said, well, they can't, that provision says you can't assert a 6662 penalty if the supervisor didn't sign off for it and give notice to the taxpayer either no later than the date on which the IRS issues the notice of deficiency, which is the letter they send to say we disagree with your position on your tax return after an IRS audit, or the date, if earlier, on which the IRS formally communicates to the taxpayer the examination division's determination to assert a penalty and notifies the taxpayer of his right to appeal that determination. So far, after this case, the IRS has really stepped up its ability to document this. And before it was kind of lackadaisical. They've always had to have a form signed off on by the supervisor, but sometimes it wasn't done timely or just kind of neglected. So a lot of the cases that come out just are that paperwork problems. We have one client with a case pending before the tax court, though, and it's a good example. They had asserted a $300,000 plus penalty in the case, but when we went to court, they didn't have any proof that the supervisor had signed off on this. It was probably likely that they had, but there was no proof of it, and they couldn't produce the documentation. Well, the courts kind of let them provide testimony, but they couldn't provide that either because no one could remember. So that's kind of a situation where it's kind of a paperwork problem, but could apply. So that's just one thing that's out there that's happened. A lot of people ask me about. Just generally with penalties, we deal with hundreds and hundreds of penalties every year. Since the IRS has gone to more of a computer-generated assertion of penalties, it's kind of assert it now and figure out if it's correct later, kind of a situation. We deal a lot more with getting them abated or waived, and so it's a whole process that using reasonable cause sometimes comes after a whole bunch of other work we do now. Typically, people will now might be able to take advantage of what they call the first-time penalty abatement, and oftentimes we can call in to get that done. If you had that penalty and haven't had one in the past 3 years, typically the IRS will abate it only for certain penalties. But then it comes to this reasonable cause. Oftentimes we have to assert reasonable cause because these are some of the reasons: unavailability of records, disasters, death or serious illness. Now, what people don't understand is they can't just have a one-time occurrence. It's got to affect all the period when they could have complied. So sometimes it's like proving, you can prove that someone was ill or incapacitated, but it lasts over the time periods when the returns would be filed, that sort of thing. And of course, reliance on a tax professional. The reason why this one's important, and I like to always promote that anytime you have a position you're taking in the tax world on a return that's even slightly questionable, you might want to get some written advice, because that can be used as a penalty defense if you do get audited. It's sometimes not brought down to that written level, but it should be. Sometimes it's even best to even disclose that and the advice you got on the return when you file it. And this is just kind of some of the requirements. Of course, if you're going to rely on a professional, you have to tell them about it. They have to actually give you advice, and you have to give them all the information that's relevant, not just the information that you want them to have. This is just a slide I like to use to show how many penalties are asserted and how many are actually abated, and this is, millions and millions of dollars, actually billions of dollars. And, you can get, just by the asking, there's a lot of relief if you just ask. If you don't ask, you have no chance. Now I'll move on to the last topic in my area, and this is conservation easements. I get a lot of questions about this throughout the year. There are a lot of people that promote conservation easements, especially now a lot of syndicated conservation easements, which kind of like the captives have become a transaction of interest that the IRS puts on a list, and you have to file an 8886 to let them know you have it. And that's essentially what it is if you in these syndicated easements, you have to report them if you pay so much money to the partnership that you enter to receive your conservation, your charitable deduction from. If you get more than 2.5 times what you put in, then the IRS considers that the threshold where you have to report it and let them know that you are involved in it. These are just kind of some things that have happened in recent years. Of course, I just mentioned in 2017, they made the syndicated easements, some call them the prepackaged easements, a listed transaction, and some other big things that happened. Well, the IRS has obviously announced that they're going to have a campaign audit for these. Although when I was with the IRS, I was a former IRS attorney, we litigated quite a few of these types of cases, or settled even more so. So it seems that the IRS thinks that they don't have enough rules out there in the cases to make things stick, or at least people aren't afraid of them. So they're planning on litigating quite a few of these if they can. So they offered a settlement for these types of syndicated easements, and essentially there's a minimum 10% penalty that you can't decrease, and then there's, of course, if you were the promoter, there's a 40% penalty, and you have to pay the full tax and the penalties. There's been some problems because you have to get all the partners to sign on to these types of arrangements, but that's kind of what's been out there. A couple things I just want to point out is that now these conservation easements, different than other charitable deductions, they have their own special rules, and that's why I'm pointing to the regs here. 1.170A-13, it requires special compliance to make sure the conservation easement works, and the IRS has been sticklers on making sure every component has been followed. If any piece has not been followed, they've been very aggressive in attacking, large or small. It doesn't have to be the syndicated easements, it can be any easement. If there's one, forget to dot your I's, cross your T's, they've gone after the easements and have not been merciful. So just some of the things that you have to have: got to be a qualified appraiser, properly done, which is analyzing the before and after value of the highest and best use. You have to include your bargain sale facts and information. So if you received any money in exchange and you didn't report that, that can disqualify the entire easement, even if it was only, 1% of it. You have to get a properly created and contemporaneous acknowledgement, which means the donee has provided the information that you did in fact contribute this easement. And then you have to have the appropriate statements in the conservation easement that preserve it. The conservation purpose, how it's going to be managed, and you have to assert that you provided all the information to the donee. Misspelling there, but another thing is the in perpetuity requirement. Lots of litigation has gone on with this, and basically it's anything in the easement that allows some changes that can affect the easement, consistency and perpetuity. The IRS has aggressively attacked these. So they've a lot of tax court cases where they've won, and some where they've had some setbacks from the IRS perspective. Additionally, the donee has to be absolutely entitled to the proportionate share of the extinguished proceeds. This has been a difficult one because there's a lot of provisions in old deeds that said, well, if the easement becomes useless and not worth it anymore, And so the property gets sold, you know, they get this value or the set of value, and if it doesn't take into account like the improvements, and then that can also disqualify the easement. Been cases about that as well. One thing I'll note is I get a lot of questions about these mining easements, and this is where someone has gone out and they found some land and they said, well, we're going to buy this land, we get a mining engineer, and we set up a business plan where they could go mine this for whatever it is that's there, rock, gravel and rock, sand, and maybe, you know, in a place where that hadn't existed before. Currently it's like farmland or something. So a lot of these have gone out. I've seen a lot of promotions for these, and I always advocate, you know, looking into them carefully, because the court has had this case out there, tax court, and the IRS uses this frequently, this Edgar case, where the court rejected a situation where they had, you know, found this property and they were going to use it for mining, or said they could use it for mining, and it would be worth so much money. The highest and best use would be this mining application. They got to watch out, because in that case, and this is the way the IRS looks at this, anytime there's the asserted highest and best use is different than the current use, I mean, you have to have a higher level of proof that that is why the market value would be anything different than what it's currently used for. So they have this closeness in time and reasonable probability problem, where you can't be a pie in the sky kind of a thing. It's like, this would actually work and soon. You got to have the documents to prove that. Some of the business plans I've seen are just, you know, cookie cutter type things that I don't think the court would accept. You just have to live by this rule that it's, I'll just read it, depends on the events or combinations of occurrences which, while within the realm of possibility, are not fairly shown to be reasonably probable, then they'll exclude that value as an improbable value, and the value will be the value at which it's currently used. So another one I'll mention really quick, and I won't run out of time here, but is the Pine Mountain Preserve case, because that is a very recent case that came out. Originally, it was a tax court case where and I'll just skip to the summary of it. So in that case, the original tax court case, this was an in perpetuity problem where they had some, in the deed, they had some easements, some windows of building that envelopes could be built, and they weren't necessarily locked in, which meant that it was a scenic easement and they couldn't, you didn't want to disturb the scenery and the conservation use, so the animals could live there, people could view it and be pretty. But they had some, probably ranch land, I can't remember exactly, but they could build a couple buildings that assisted in the use of the property as it was, because, in a lot of these easements, you have your continuing buildings already there, and the easements sort of on everything else around it prevent any other development. But it allowed for a few other things, as long as that was taken into account in the valuation. So originally the court said, well, you can move it all around, and so because you can change the places where you can build this, it's not really in perpetuity, amongst other things. So what happened recently is the 11th Circuit reviewed this case and found that the IRS and the tax court had not lived by their own interpretation or reading of the rules, and reversed it, saying that in perpetuity could mean that, it's completely described in here. They can understand what could be built and where it could be built, and even that included this envelope, but it was limited in size, the movement of the envelope, that the court determined that it was wrong. So in the 11th Circuit only, this is different. So it's still, overall in the tax court, you still have this problem of, what we call floating easement. So I'm at the end here, and I know I went through fast, but please, feel free to go back to those slides and ask me any questions. They're very nuanced and difficult subjects with a lot of case law out there. And I'll pass it off now to Ava.
Thanks, Ben. Good afternoon, everyone. I'm going to share, as I said earlier, an update of where we are in the environment of estate and gift tax under this kind of strange year that we have had. So what we do know this year is that our estate and gift tax exemption is at 11.58 million. That's indexed for inflation for 2021 at 11.7 million with a rate at 40%. So you can gift or die with assets at 11.58 million this year, not owe any tax. Once you go over that amount, the tax is at 40%. And this is true for gift, estate, and GST tax. And if you're not familiar with GST tax, that is the tax, separate tax that comes about if you're going to transfer assets to a skip generation. So instead of leaving your assets to your children, maybe you leave them to your grandchildren. There's a threshold of how much you can transfer to that skip. We do have portability still in play, and if you're not familiar with that term, I'll mention that here in a few minutes. And our estate tax exemption under the tax reform in 2017 is set to sunset in 2026. So the estate and gift tax exemption provisions that happen as of January 1, 2026, that amount is going to drop to 5 million index for inflation. And what we believe that to be is about $6 million by the time we get to 2026. We also have annual exclusion amounts of $15,000 per person for 20 and 21. That means you can transfer $15,000 to any individual and then not have it dip into your estate and gift tax exemption. And that's per person. So a husband and wife could transfer $15,000 each to a child, transferring $30,000 in 1 year. In our environment today, we have unbelievable low interest rates. So the IRS monthly sets out their AFR rates, and as of November, the 75/20 rate, which is the rate we use for most gifting techniques, is at 0.4%. I don't remember it ever being that low. And even rates for a long-term note at this time is 1.17%, which is considerably low. A term we're hearing clients talk about is clawback. Clawback, if you're not aware of what that is it's a term used for the concern that if I use my $11.58 million exemption today, and in 2026, that exemption drops to something lower, will the IRS claw back or tax me on that bonus amount between the $6 million, what we think it is going to be in 2026, and the 11.5, what it is today? So that $5.5 million difference, I think of it as a bonus. Clients were concerned that IRS would try tax that bonus amount. So if I gave away my 11.5 today and I died in 2026 and it was 6 million, would I be penalized for using a higher exemption previously? And the answer is no, based on final regs that came out in November of 19. So the estate tax exemption at death is computed using the higher of the applicable exemption to gifts made during life or your exemption at death. So if during life I used my applicable exemption for gifts, I'm not going to be penalized if in 2026 it's something less than that. Another concern our clients have with this higher exemption is, can they gift that bonus amount, that 5.5, that difference between the 6 million and the 11.5? Can they gift from the top and use that 5.5 in 2026, still have $6 million available to use for gifts? And the answer is no to that as well. The exemption is used from the bottom up, not the top down. So if the client was thinking that they could gift some part of that bonus of that 5.5 that we have right now for gift and estate tax purposes, they actually would be using 5.5 million of their exemption that they have in 26. So let's say they gave 5.5 million away today, thinking that was their bonus amount. And in 2026, they would have their $6 million, is where we're going to drop to, as we know the law today. they would be surprised, because what they would have left is only $500,000 of exemption to use for the rest of their life. So remember that you use your exemption from the bottom up, not the top down. And if you're a husband and wife and you're looking at making a large gift, you may want to make that gift all from one spouse instead of splitting it between the two spouses. In my example, if I gave away 11 million, 5.5 apiece, well, in 2026, the spouses would only have 500,000 each, where one spouse gave away 11 million, used up all of his exemption, let's say, his wife, if it was a husband, the wife would have still her 6 million in 2026. Now, portability. That's something that came into play or became permanent in 2012, and it's a great benefit, I think, for taxpayers. Before 2012, when you made gifts or you died with assets, if I didn't use my exemption, all of it on death with those gifts or transferring my assets to someone on death, I would lose that exemption. So I can transfer anything to a spouse or charity and get a free marital deduction or a charitable deduction. But if I transfer assets to anyone else, it uses my exemption. So in my estate, if I transferred everything to my husband before 2012, I would have lost my 11.5 million. My family would not have gotten the benefit from it. But now, with portability, I could leave everything to my husband or the person representative of my estate could file an estate tax return and make an election to pick up my 11.5 million and transfer it to my surviving spouse. That 11.5 million, if I died today, wouldn't be lost in 2026 or adjusted for sunset. It wouldn't adjust for inflation, but it would still be there. My husband would use that first toward gifts that he makes, because when he reaches 2026, he would have my 11.5 million, and then whatever the exemption is, let's say in 2026, when it drops to 6 million, it'd still have the 6 million. If he made any gifts in the meantime, he uses it from my exemption first. Planning for portability, some people think it has made things more simple. Some people have the thought that it maybe makes it more complex. I think it's a little bit more complex because I look at it as an after-death planning tool. You don't always know until after death whether or not you want to make your exemption portable to your spouse. It really is going to depend on the age of your spouse, the health of your spouse, and the assets you hold. Because any assets that I have at death get a free stepped-up tax basis to my beneficiaries. So that's kind of the beauty of having estate tax. Estate tax, yes, causes tax for our higher net worth people, but for everyone in the country, they get a stepped-up tax basis because of the estate tax to a fair market value as of the date of death. So if they sold it the day after death, there's no capital gains to pay. So with portability, if I transferred all my assets to my husband when I'm in my mid-50s, if he lives for another 30 years into his 80s, our children would get a second stepped up tax basis. Their new tax basis would be something much higher. Those are the kind of things you want to consider when you are working with portability. Now, planning in this current environment we have, there's been a lot of strange things happening in the country, as in addition even to the COVID pandemic, that have caused suppressed values, both in the market and in some cases, and for our closely held businesses. We have a historic low interest rate, like I mentioned before. We have a government deficit without a massive bailout, and there may be more bailouts coming our way. We have clients who are now concerned about asset protection and access to funds. Clients who maybe would not have been concerned about creditors before are now thinking about that, or even the children are asking, sometimes the parent level, that if you are going to gift to me, gift it through a trust so I make sure that I have some creditor protection for the assets that you give me, just in case something happens to the market or to my business. They want to be protected and protect those family assets. Clients who were looking to gift large gifts and maybe using that $11.5 million exemption before, they now are thinking, I maybe do want to use that higher exemption, but I want to have access to the cash flow just because I don't know what may happen before us. And this year has spooked some people on their cash flow. So there are techniques we can use where we can gift the exemption, but keep the cash flow back to us. That's very popular just because of this unknown environment we're in. We also have the future adjustments to the estate tax exemption, which has been a topic as these political campaigns have been about throughout the year. So Biden and Sanders had a unity task force where they gave recommendations in July where they mentioned that the estate taxes would be raised back to a historical norm, but they didn't mention what that historical norm was. Was that maybe making the sunset provisions of 2026 happen sooner than 2026? We don't know, wasn't clear. But there were discussions during the political campaigns that the Democrats talked about dropping the estate tax exemption to something as low as 3.5 million and raising that rate, the estate and gift tax rate, from 40% to 50 to 55%. There was also, I've heard Biden mention in some of his speeches about doing away with the stepped up tax basis. Now, I just mentioned that's a benefit to have a stepped up tax basis. That's part of the benefit of having estate taxes. All our beneficiaries get a new tax basis. If we did away with the stepped up tax basis and had estate tax at a lower exemption, that could be significant. Hard to believe that that would happen, but there is discussion about both of those items happening. There's also discussions that if the changes would happen, could they make them retroactive? So, especially since we don't have an answer in the Senate, we don't know exactly how this control will play out. But if some change came and it came later in the year, would they make that retroactive to January 1? There's been discussion throughout the year in some national commentaries, professionals in the country who really focus in this area that have had some concern about that. I think it's becoming less of a concern as we see the numbers come out in the Senate, but it wouldn't be unconstitutional, but I would be surprised if it would make that retroactive. But with all that said, time is now to plan because many people in their planning documents do not provide for the flexibility of portability to leave that option on the table at death, or provide the flexibility for a change in the exemption. The flexibility in their documents is the language written in a manner that allows you to still have a good plan if the exemption drops. I just reviewed a plan in the last couple of weeks for a client, and it was reviewed by the attorney a couple months ago. I think it was at the end of August. And I was surprised, very well written legal document, but it really didn't have anything that provided the client the flexibility for using portability or deciding to use portability at the death of the first spouse. And it didn't provide flexibility for the change in the exemption. So if you have planning documents, think about that. If you're looking at it from the tax perspective, with these changes, do these documents still make sense? The other thing to think about is if you were thinking about using the higher exemption of that 11.5 million, we have a number of clients that when tax reform came out in 2017, and they increased this exemption for this time period between now and 2026. A lot of clients were thinking about, should I use this bonus exemption now or should I wait? Well, now if you were thinking about using it, maybe it is the time to step forward and use that. Or maybe you set yourselves up so you're ready to pull the trigger in case it looks like a change would happen in the law. I have some clients who are putting trusts in place right now, not funding them, but getting them ready. So if they wanted to gift assets, they could do that quickly. I have some clients who are looking at their businesses. I'll use a real estate holding company, for example. They are breaking up the low basis assets and the high basis assets into two separate partnerships and they'll gift the high basis assets. Or another client has a partnership that has some assets that may appreciate significantly. They're going to break those out and they're going to be ready to use that for gifting purposes if it looks like the exemption is going to go away. To me, this is deja vu of 2012. In that year, the exemption was at $5 million and it was going to drop to $1 million. The end of that year was the busiest time in my career because many people wanted to use that exemption before year end. And we did a lot of planning. But the unexpected happened is that that 5 million really didn't drop. And some people used the 5 million and regretted it in 2013. So if you're going to use this higher exemption, make sure you're comfortable with doing that. Don't do it just because you think there may be a threat. And if you're going to, make sure you're set up that you can still have a comfortable lifestyle if you do use that higher exemption. But the time now is to have the discussions, work with your professionals, really look at your assets, set yourself up. Like I said, be ready to pull the trigger, but make sure you think about your cash flow if you do something like that. So for our mid-size estates, and I think of mid-size estates of anything about 12 million to 20 million, people who may owe estate tax in 2026 when the exemption drops, or may owe estate tax now, you're kind of in that window. It's a good time to look at your planning documents. If they were drafted before 2012, before portability came into play, make sure they still make sense. Many of those planning documents were drafted with a credit trust and a marital trust, or maybe everything goes to family trust and then the balance to use the exemption and the balance goes to outright to a spouse or a marital trust. Many planning documents before 12 made sure you use all your exemption on the first death because portability wasn't there or wasn't even known about. So if you have those older planning documents, take a look at them, see if they still make sense. Have someone look at them from the tax perspective. You might want to consider maybe you leave everything to your surviving spouse and let your surviving spouse decide if they want to fund a trust at death. They could disclaim those assets, give up the right after the death of the first spouse, put them in a trust at that point. That way they can decide if they want to use the portability exemption rules or not. You also could look at doing a marital trust that allows part of the marital trust to be taxed on the first death or the second death. To me, again, I'll use my example. At our mid-50s, if one of us would die, we hope that we would remarry, but we want our assets to pass to our first children. Sometimes these marital trusts that we create can help protect that, as well as protect us from leaving options on the table for the exemption and portability. That's the goal. Have your planning documents leave those options on the table for you. So what planning ideas are we using in this unknown future that we have of where the exemption will go, how the economy will play out in the next couple of years? Well, we see a lot of interfamily loans. That is one asset that if the exemption dropped quickly, it's very easy to gift the balance of a promissory note. That's one thing you might want to think about. Another thing is if I wanted to use this higher exemption today, but I really am not comfortable giving up the cash flow, maybe you want to think about a spousal access trust where I transfer assets into a trust for the benefit of my spouse while he's alive, and at his death, it would go to the children. In doing that, as long as we're married, I have the income stream, but I've used my exemption today. You also could look at a sale to a defective trust. An irrevocable defective trust is a trust that if I transfer assets to that trust, it's out of my estate for estate tax purposes, but it's written in a manner that it's still taxable to me for income tax purposes. There's benefits we can do with that type of trust in that we could sell assets to that trust for today's value and take back a promissory note. Then if the exemption drops, I give up the promissory note. So I'll explain those two techniques here a little bit more in a few minutes. The last thing to think about in this environment we're in is if we do get to someone who wants to decide last minute they want to make a gift before year end, might not have time to get the appraisals or the business valuation to do so, we can still gift those assets, but we want to make sure that the assignment documents are written with a defined value clause, basing it on value and not an asset. So now with the loans, when I talk about inter-family loans or interrelated loans, there are many of them that we see between family members or family entities. And in these environment of a low interest rate, what we're seeing is a lot of people refinancing those loans, which makes sense. But if you do that, you want to make sure that they are looked upon as a business transaction. So you might want to provide consideration like maybe partial principal payments or interest, higher interest if you paid off early or in default, or higher interest, higher than the AFR, just so it's a little bit more than what the AFR is, so it looks like a business type transaction. Ensure the payment is made. You could have a prepayment allowed, but treat it like a true loan. You want the loan to be like a bona fide business transaction, so it's not looked at as a gift. They should reflect the interest rate, the term, the due date. You still want to have flexibility, like I said, as a prepayment clause. Maybe interest only with a balloon is a great idea and allows some flexibility. But maintain the records. Maybe you have security, or you secure that note, give some collateral, but you want to make sure you have the financial capacity that the payments on the note can be made. You know, make sure whoever you're doing this transaction with is financially solvent. So this becomes, I think, even more apparent this year with a tax court case where a mom, which we see a lot, parents make loans to their children and then they forgive parts of the loan as maybe an annual exclusion gifts, or along the way they've forgiven the loan that they made to their child. That's all fine. And this mother did this for many years and then died in the recent years and included that note on her estate tax return as an asset because there was a balance owing with one of the sons. However, the IRS went back to 1989 and said he became financially insolvent in 1989. So that gift happened in 1989 when he could no longer pay the payments that were required under that note. Mom knew that. She had an equalization clause put in her planning documents to be fair to the other children. She thought she was doing the right thing. But when IRS saw those equalization clauses and realized that he could not pay this note, they came back when she filed when her personal representative filed her estate tax return on death and said, that gift happened back in 1989, caused a lot of interest and penalties to be paid by that estate. So if you are making any related gifts, make sure you are documenting it with evidence, with a written note. You have interest, maybe security or collateral, have a fixed maturity date, have a demand for repayment or actual repayment, note the ability for repayment. If you think they won't be able to pay, maybe make it an interest only note so it is easier that they can make payments if required. But track it just like you would if you were doing a business transaction. Now to these three techniques that I talked about: the spousal access trust, the sale to the grantor trust, and defined value clause. I want to just touch on those or illustrate them for you so you can maybe help. These illustrations, I hope, help understand how the flow works. So if I was the grantor in a spousal access trust, I might transfer assets to a grantor trust with my husband as the income beneficiary. Since my husband's the income beneficiary, this is not going to be an income savings technique, because when my husband is the beneficiary, it's a grantor trust. I still pay the income tax and everything in that trust. But I could transfer 11.5 million today to that trust, give my husband the income stream. The balance at his death could go to children or stay in trust for the children. And I've gotten that 11.5 million out of my estate while I have this bonus exemption available. I didn't give up the cash flow as long as I'm married to my husband. So it's a great way to think about how to use the exemption, but still keep the cash flow. Things you want to think about here is that income could be discretionary to the spouse or the children. You could have an independent trustee involved, and if you do, you can even have broader discretions with principal. The trust is not includable in my spouse's estate. So I'm making really a gift from myself to my children who were the remainder beneficiaries. Their tax basis is going to be my basis today. There won't be a step up on my husband's death. The gift is made, the exemptions used today if I did that in 2020. And each spouse could do this. I could create a trust for my husband, and my husband could create a trust for me. So we both use 11.5 million, but we want to be sure that they're not looked upon as reciprocal trusts, that it's all one transaction. So in those trusts, you want them to differ somewhat. Maybe powers are different within the trust, or they're in different states. The distribution amounts may be different. One trust may have a trust protector who can make changes to the trust, and one may not. And one may be for children, one may be for grandchildren. There's a lot of flexibility you can do if you want to use your higher exemption, but keep the cash flow. Now the sale to the IDGIT, that's a different transaction in that case, if I was a taxpayer and I created this trust, I transferred assets to the trust, but I didn't use my exemption. I took a promissory note back. This would work really well for if I had someone who had an asset they knew that was going to appreciate significantly. So let's say that real estate property that's right outside city limits might double in value sometime. Today, at today's value, I could sell it to the trust, take a note back for today's value, and if it sells 5 years down the road at double the price, all of that appreciation's out of my estate. What do I have right now is this note in my estate. And in these times, when you don't know where the exemption is going to be, it's a great way to have the trust set up. I have the assets transferred over. It's a grant or trust. I'm still paying the income tax on it. And if the exemption is going to look like it goes away, I just gift the promissory note. This is one of these tools where I'm saying, set yourself up to pull the trigger. This is an example of that. The benefits here, again, it's a way to use, to shift the assets to a trust, ready to use that higher exemption if I need to, and I would do that by gifting the note at the time I thought the exemption was dropping. For the defined value clauses, I just want to make a point again. If we get to year end and you want to make a gift before year end, but you don't have time to do maybe an appraisal or a business valuation, you can assign that with an assignment stating, I'm making the gift based upon a certain value amount. It's great to say that you're doing it based on a value as finally determined for gift and estate tax purposes. That way, if there's an audit on your gift tax return, it's just going to adjust the gift. They can't come back and collect any more tax because you're saying your gift value is going to be whatever's determined if there is an audit. Be careful, though, that you have the right language. There was a Nelson case this year, in this past year, where they said they wanted to transfer it based on a qualified appraisal. Well, that didn't determine the value, and it didn't determine the value based on determined by gift and estate tax purposes, meaning an audit. It was just whatever a qualified appraisal would come up with. That didn't quite cover it for the defined value clauses. So a couple quick other things to mention here in my last few minutes is at the end of 19, the Secure Act passed. And the main thing I want to point out on the Secure Act, the big change is that we used to hear about IRA plans on death, that they could be paid out for what you would refer to as a stretch IRA over the life expectancy of the beneficiary. That has now been taken away under the Secure Act, except for a few eligible designated beneficiaries who are like a surviving spouse, a minor, a disabled person, chronically ill person, but for the average child who receives an IRA, they now need to take those funds out of an IRA account on their parent's death over 10 years. It could be in the 10th year, but if you go past that 10th year, it's a 50% penalty. So if you have any of these IRAs that were paid to a trust, now that this time is set for 10 years, that might change what your plan was through that trust. It still might not make sense. So you might want to have that reviewed. Also, if you don't want your children to have those funds over a 10-year period because of the size or for some other matter, you might want to look at doing a planning with life insurance or with a charitable remainder trust. There's some planning you can do to still help get a stretch amount to the children. The other item I wanted to share with you is on the CARES Act, that this CARES Act was after the coronavirus came into play. But one term in here provides for, if you find yourself meeting the statutory definition of a person harmed by the CARES Act, by the coronavirus, either the taxpayer or the spouse diagnosed with COVID, or you experience financial adverse consequences, there's kind of a checklist you need to go through. If you find yourself in that category, you can take a $100,000 distribution out of your IRA, and you don't have to worry about a 10% penalty on early distributions. The distribution has to be in 2020, and the income can be recognized over a 3-year period. Now, there's a number of advisors talking about taking this $100,000 and putting it into a Roth. I caution you about that. I really ask that you visit with your tax advisor on that. There's some that was not the intent of the IRS, and I think you have to be prepared for some adverse consequences if you choose to do that. The other thing in the CARES Act are the charitable deductions. There's 2 benefits that happen there. One is a $300 deduction beginning in 2020. If you do not itemize, you'll still get a $300 deduction off kind of the front of your return. And if you do itemize, cash gifts used to be limited to 60% of AGI. Now in 2020 can be 100% of AGI, but it must be, it does not work for donor advised funds, and also does not work for private foundations. I see I did not list that here, but it's also those 2 things. You can't make the cash gifts if you want the 100% of AGI, if you make the gift to a donor advised fund or private foundation. The trust income tax updates, those did not change, but just a reminder for trust, they're similar and the same as the 1040s, the personal returns. You have the deduction for state income taxes and real estate taxes limited to $10,000. Miscellaneous itemized deductions are not allowed. However, administration expenses for the expenses that would not have been incurred if I didn't have an estate or trust, those are deductible. And that's fiduciary fees, legal fees, tax prep fees. Just had a final reg that came out on that, making that a final decision there. Estates and trusts are allowed the 20% deduction for QBI income, and the net operating loss rules here have been changed under the CARES Act as well. Now have a 5-year carryback, and it removed the 80% limit on the carry forward years. The tax rates, just something to think about with trust and estates. If you don't distribute out of a trust and estate, your tax is at the highest tax bracket at $13,500 for 2021. With that, always think about permanent only means permanent till the tax law changes. So the best planning documents you can have provide for flexibility in your planning documents. I'm just going to check here. I have a couple questions. Is a GST exemption portable? And that is a no. And how do you plan for the chance of dying at the same time as your spouse if your plan is the surviving spouse making trust decisions? Usually there are provisions within those legal documents that will say, if we die in a common accident, who dies first? So there could be a benefit for you to be thinking about which one makes more sense, and if so, you'd want to put that in your planning document. Great questions. And with that, I think I'm going to turn that over to Shannon.
Excellent. Thank you, Ava. All right. Now to the international tax update. I'm Shannon Lamont, partner in charge of international tax services for Eide Bailly. It's great to be with you today. We'll get right into it. I wanted to just first update, or not update, remind you of some of the CARES Act provisions that have an international impact. The CARES Act seems like decades ago at this point, but then nonetheless, we should be reminded of it. First off, reminder that because there's a carryback, potential for carryback of NOLs after 2017, and within that, you can elect to skip the 965 inclusion year. So if you had a 965 inclusion, that typically income that was taxed at a relatively low rate. So you might want to take that provision. It also removed the 80% limit on NOLs, which could impact other things such as the BEAT tax. And there was an increase in the allowance for business interest deductions, also could impact other items from an international perspective as well. So for the 2018 to 2025 years, remember that GILTI income is taxed at 10.5% after the Section 250 deduction. With those domestic net operating losses, they have the potential to reduce the Section 250 deduction. And also the foreign tax credit is allowed up to 80% of foreign tax credits paid for GILTI income, but there's no carry forward or carryback. So when you're looking at those NOL carrybacks, just be very careful that you're not missing out on some taking or losing out on a permanent deduction or foreign availability of use of foreign tax credits. So under the current law, if prior year GILTI is offset by an NOL carryback, the value of the carryback is reduced because the GILTI income was only taxed at 10.5%, and those foreign tax credits can't be carried forward, as I mentioned below. So just to think about an example where we had a loss that was available to be carried back, that the value of that loss would be equal to the 21%. So it would have a value of about $2.10 on a $10 loss. But if we had a GILTI, that benefit is actually only worth $1.05. And then if you had foreign tax credits to then offset that GILTI, your value of the NOL may even be zero. So keep in mind also, as I mentioned, the 965 inclusion, you can forego the use of the NOL in that year. Also keeping in mind that if you are carrying back an NOL in order to get a refund, if you have an outstanding 965 tax amount that you elected to defer over the 8 years, you would not get a refund unless that NOL the NOL carryback exceeded the amount of tax that is still due on the 965. For business interest expense, the point here is just to keep in mind that if you do take advantage of the additional 163J limitation to 50%, the increase in the NOL may not necessarily be favorable for taxpayers with GILTI, as we previously discussed. Also wanted to mention just some of the BEAT interactions. I know we don't have a ton of BEAT clients, but wanted to mention it anyway. The base erosion alternative tax is a minimum tax on related party payments. The one thing to keep in mind here is NOLs then changes create a lower regular tax liability, and that could increase the likelihood of a BEAT liability because it's a minimum tax. Also, that additional interest deduction that is available could, in addition to the NOL changes, that also may reduce regular tax liability and therefore increase BEAT liability. There are many foreign countries that are implementing similar NOL carryback or increased interest deduction provisions, and this could result in foreign tax redeterminations. That means that under Section 905C, if you have a foreign tax redetermination, you are required to amend your tax return to reduce your foreign tax credit. So that could result in incremental US tax. So definitely want to be coordinated in terms of when those claims are made. Also keep in mind that there was a change to the qualified improvement property, and this qualified improvement property change does impact the international space as well, because depreciation life is relevant for earnings and profits, GILTI and FDII deduction calculations. So keep in mind that if you are making those changes, you need to make them on a global basis and update those calculations as well. So these are just some considerations for companies with respect to the CARES Act. And I think that I have talked quite a bit about the first one, which is the 163J. Looking at companies with 100 or less employees, considering the employee retention credit. This is mostly just thinking about companies that have that are foreign parented, that have US operations, and also considering the net operating loss carryback, and the PPP loan is passed. So I should have taken that off the slide actually. For companies with expat employees, we'll talk about this a little bit more in detail, but we want to be really careful about residency status. That can have implications both for the individual and the company. So thinking about that. Also, if an individual is in a country for longer than they expected to, that could even have payroll tax implications, where typically, you can be in a country for a certain period of time without triggering some of those obligations from the company perspective, and that may be a change that you need to be thinking about. Also, if you have implemented a tax equalization policy for your expat population, the computations would likely need to be adjusted or updated if you've done a projection to take into account any changes in whether the employee stayed in a country for longer than expected. And then for U.S. companies with foreign business operations, just again keeping in mind the impact on a net operating loss carryback on other provisions. There have been quite a lot of adjustments and changes to customs and duties, so watch those as well. And then also with during these uncertain times when you might have unexpected losses, et cetera, it's a good time to look at your transfer pricing policy, keeping in mind where the functions and risks are, and the allocation of losses, and how what would make the most sense from a company globally. I also want to point out that during this time, during this COVID season, to be thinking about loss planning. So some of the items to be thinking about are, do you have a CFC that could be eligible for the worthless stock deduction should you liquidate it, or for instance, make a check the box election? And there's a lot of requirements to that in terms of whether it would be available, but it's something to look at. Now is a good time because there is an event, right, that's happened that you could point to say, this is the time when the stock became worthless. Also, if you have intercompany debt, keep in mind that it could be available a bad debt deduction or cancellation of indebtedness income exemption for insolvency. So taking a look at those notes and seeing if now is the time where you should be taking a bad debt deduction, given that you may not be getting paid from the foreign subsidiary. And then also, we always think about checking the box on entities. So if you have a foreign entity that has continued losses, again, there's lots of other things to consider with respect to this as well, but thinking about checking the box to include those losses in the US. For US citizens that are living and working abroad, some of the things that they can be considering is whether those permanent or temporary relocations during this time might change immigration status, tax residency, and other filing positions, such as the ability to claim the foreign earned income exclusion. Also looking at whether there are, I mentioned this previously as well, but payroll implications for the company, and also the taxation of potential expenses that were reimbursed for the employee's relocation or the family's relocation. In addition, the COVID-19 recovery rebate payments, those likely went, we've passed that as well. But it could be that those could be coming out again. So be thinking about how that impacts the taxation in the other country. And if you have residents or non-resident aliens living and working in the US, then thinking about, again, same things, the immigration status, et cetera, and permanent and temporary relocations could have impacts on if the individual has stayed here because of the COVID situation and they are working from here, but they are on a foreign payroll, for instance, then that foreign company could have, or will have, I should say, implications with respect to payroll taxes as well. Then I wanted to talk about residency just a little bit more amid the COVID-19. So with residency for individuals, a lot of times in other countries, they look at a number of different items like family or social ties, citizenship. The US is one of the few countries that taxes based on citizenship. Permanent resident status, although there are likely treaty exceptions there. They look at economic ties, home location, and also physical presence. If you do obtain residency because you have you've been put in a position where you are in the country for longer than anticipated due to travel restrictions, then you would have worldwide income taxation in various countries such as Australia, Canada, Netherlands, UK, US, for instance. Those are some of the examples. But then also be thinking about other taxes such as wealth tax, gift and estate tax, or even an exit tax. The other item to be thinking about is whether there might be tax reliefs available should your residency be changed unexpectedly. And Ava was previously talking about trust and estate issues, and we deal a lot with situations where we have individuals who have an estate in multiple countries. And so it's important to point out that if you have a foreign person that is living in the US or they have assets in the US, they could also be subject to gift and estate tax here. The implication, well, it's residency is different for gift and estate tax purposes, and then it looks at domicile rather than your days present in the US, et cetera. And the US side assets are subject to tax from 18% to 40%. If you are an NDA, no present which means that you have no present intention of staying in the US indefinitely, then if you are here and somebody passes away, that estate tax exemption amount is limited to $60,000. So you want to be careful about if somebody is coming to the US temporarily, let's say they contract COVID and they pass, we need to be thinking about what assets they have in the US and whether they're subject to gift and estate tax. Or estate tax, I should say. So one example of this is an employee that moved to the US for a 3-year assignment and they purchased $1 million home. If they were to pass while they are here, they would be subject to tax of $332,000. So that's taking into consideration the reduced $60,000 exemption. Also wanted to point out that there are a number of personal tax relief measures that were made in other countries. So keeping these in mind is important if you have a population of employees, for instance, that are working in other countries and are there for a period of time. These will impact also the potential equalization calculations. So be cognizant of those. I've listed out a number of those here just for your benefit, and you'll have the slides to go back to if needed. And then company considerations related to residency. And I should say residency for where you have remote employees. And this is coming up a lot in these days where a lot of companies are allowing individuals to work wherever they may be. And although it seemed like that would be a temporary item for many businesses, it looks like that is trending towards potentially even moving into a policy of being able to work from wherever. Other countries often use the concept analogous to the US state's nexus to connect cross-border business to their income tax. So you would need to be trading in the country or doing business. And we call this, from an international tax standpoint, permanent establishment. And employees working remotely in a country can create a permanent establishment for the company. So we need to be careful about this if we have a policy of work from anywhere. Income tax treaties can modify how these rules apply, but these treaties only cover income taxes. So they would not change Social Security, payroll, and value-added taxes. And really what we see as value-added taxes are one of the main triggers for needing to evaluate this. Because you can, if you have an employee in a country, that is one of the items that they look at to see if you are doing business in the country. Also, some countries have announced some relaxed measures on how they view an employee's presence due to the coronavirus pandemic. Examples, Australia, Ireland, and the UK, but we would expect that those are not going to be permanent. So we need to be thinking about that, about this from a company risk standpoint. So if you have, if you're a company that has remote employees, keep the issues that we need to be thinking about are the withholding taxes. So think about all the withholding taxes that you have for employees here. The same things could apply in other countries. In addition, the social taxes, the US has a Social Security tax agreement with many other countries, and that can help mitigate that, but it is not a permanent solution, so we need to be cognizant of it. In addition, you may have some other requirements such as needing to provide healthcare, et cetera, and comply with the employment laws of another country. This could, if you had a remote employee in another country, could require that your company registers there. So you want to be careful about that. Looking at employment laws and work visas to make sure you're not getting the company or the individual in trouble. And then also, I mentioned this before as well, but creating a taxable presence for indirect taxes is usually what happens before income taxes because we have treaties. So be thinking about whether, just be cognizant about whether that may be an issue for the company as well. And then this is really just an overview of things to be thinking about from managing a mobile workforce. The company should start with a policy. B, if you have individuals that are working in another country or for a foreign subsidiary, for instance, we generally see a secondment agreement. So an agreement that would hopefully prevent the US company from being taxed in the other jurisdiction because of that individual's presence there. If it's more of a long-term situation and something that the company has really pushed for the individual to do, oftentimes we see companies implementing a tax equalization program as well, where they make whole for any additional tax that the individual would pay. And this is especially important for US companies because in general, the US individual tax rate is lower than it would be in, let's say, a European country. So oftentimes, in order to incentivize employees to take a position with a subsidiary, they need to equalize them. And then also just the payroll that can get very, if you have somebody on a secondment arrangement or a tax equalization policy, the payroll and withholding can be a bit complex. And of course, at the tip is the tax return. Ultimately, you want to make sure the individual is doing the right filing so that you, as a company, aren't going to put your employee in a position where they're in trouble with the local tax authority as well. This is an example of a real life case that happened this year. We had a UK company that employs a US citizen. That US citizen was, working, living in the UK, and then they moved back to the US in March because of the COVID situation, but they continued to stay on the UK payroll. In that case, the employee also concluded contracts on the company's behalf because they were in a sales position. So what happens is the UK company was subject to US employment taxes and withholding obligations, in addition to the social taxes. And there was also a very high risk of possibly creating a permanent establishment for the UK company from a corporate tax standpoint. And unfortunately, the employee is not eligible for a foreign tax credit on the US source income. And they kept the employee paying taxes in the UK even when they were working in the US. So now they have to go back and remedy that by filing for hoping to get refunds of the UK taxes that were paid. In addition, there would also be some state tax implications to think about. There are also, wanted to point out from a corporate tax perspective, plenty of tax relief measures. In Australia, for instance, having an instant asset write-off, the tax residency requirements were relaxed, tax return filings were delayed. So a lot of the similar things that we have done here in the US as well. In China, there are tax cuts and a temporary reduction of their corporate income tax for certain industries, and tax payments were deferred. In Germany, they have a similar loss carryback and deferral of tax payments. In India, the EPF contribution was reduced 12% to 10%, and there were also some other tax collection at source reductions, filing deadlines extended, etc. In the UK, there was a business property tax that was waived for certain sectors. And of course, you have probably heard about the US tax relief measures. And then there are also, I wanted to point out, many countries reducing their indirect taxes outside of the US, often called GST or VAT. And so those could also impact companies doing business in other jurisdictions. One thing that has come up for our clients is that VAT is sort of paid along the value chain. And so one relief measure is to look at whether there are bad debts. So if you're charging a customer and they end up not paying, then you have the opportunity to get a refund based upon their inability to pay for that VAT tax. And then for in terms of tax enforcement policies, some countries have had suspensions of tax audits and extensions of statute of limitations. In the US, of course, we have had our business support loans. In the EU, there's also been some temporary state aid, such as direct loans or subsidized interest rates. And country by country reporting was extended, which is something that would generally apply to larger multinationals. That was extended in various countries as well. And this is just a snapshot of some of the stimulus. And this stimulus shows, as you can see, that the US gave about 9.8% of stimulus, of GDP stimulus money to its taxpayers, whereas countries such as Germany gave about 20%. So it's interesting to see the very wide range of stimulus support provided by these countries, and also thinking about, okay, well, when this is all said and done, how are we going to pay for this? So I would expect that we're going to see some adjustments, maybe to indirect taxes in the European countries, but income taxes potentially as well, just to pay for these stimulus packages. So with that, I will check questions. Excellent. Well, that is it for me. So I think we've ended right on time. Yeah, and of course, if you have questions for any of us, our contact information is listed here.